Investing is a long term play that no doubt has its ups and downs along the way. Our guest today is Brandon Beavis. His YouTube channel, Brandon Beavis Investing, with over 76,000 subscribers, helps Canadians learn how to invest in the stock market with a particular focus on long term investing. In this webinar, we discuss how you can become a more resilient investor during times of uncertainty. And I welcome my guest, Brandon Beavis. Welcome to the webinar.
Hey, Ryan. It is awesome to be here. Thank you guys for having me, and thank you to anybody at home who's watching and tuning in live. It is really a pleasure to be here.
Well, no, it's a pleasure for us to have you. Why don't you tell those who don't know you very well a little bit about what you do?
Very briefly, I know we do have some that actually came over from the YouTube channel, as you mentioned at the top of this little segment here, but I do operate a YouTube channel where we focus on Canadian investing in the stock market. I'm relatively young in the big scheme of things. I'm only 25 years old, but I have actually been working in the field for the past. So there's a firm that I've worked at. It's actually my father's investment firm. And I've got a bit of experience there working with actual portfolios. I got my license when I was 20, and I kind of parlayed that into, like I said, it's a YouTube channel where we just try to teach everything investing related, from beginner topics, stocks to buy, different terms, just really trying to help inform Canadians about the importance of investing.
Well, that's great. I know our clients are very, very well gifted for you to be here today. And today, what we're going to do, looking back at many of the previous economic meltdowns or market crashes, one thing that many investors regret is, why didn't I buy more stocks? So, Brandon, my first question to you is, how can we avoid that feeling? Or should we even try?
Good question there, Ryan. I don't know if we can always avoid that feeling. I think it's a good ending to the question there. When it comes to the stock market, I feel like you're always going to be able to look back and say, I should have done this. I should have bought more. Or I should have held off. There's really a million different things that could play out. And where I think an investor can benefit from the most is actually starting with really educating themselves and really putting the time in to have the right expectations. Being in that right frame of mind, we can be best prepared to handle that properly. And I really do think it starts with education there. That's something I'm a pretty big promoter of, because when you do understand how the stock market performs over time, and if you look at any major chart or any major long-term performance of a strong index, let's call it, you do have the ups and downs. You do have those bumps along the way, but it tends to just trend upwards. It trends to the right with time. And if an investor can grasp that, if they're able to look past the short term and they're able to just take a step back and look deeper down into the future, you then see those dips, you then see those market corrections as nothing more than opportunities. And I think that's really the way that someone should approach it, is that if we understand this is just part of the process, there's no need to panic. There's no need to fear. We really should, our eyes should be lighting up as they are truly buying opportunities, assuming we're looking at good companies, assuming we're looking at a good, strong stock market.
Yeah, that's a good, and I guess it's good advice for life itself, not just the stock market.
There's so many emotions tied to things, and especially as a new investor, you're very susceptible to getting caught up in the short term in the moment. Take a step back, just take a breath, and often when you're able to see the long term, that can keep you so much more rational. You'll be far more likely to make good decisions.
Yeah, I know when we look at those charts, we look at the 10-year, 20-year charts, we can logically make those decisions. We look at them and we say, okay, I see those market movements. I see that this is what happens. And, the logic side of me understands. But I really feel there's more to it. You mentioned it a couple times. It's more to us humans. We're emotional beings. I'd never ask how to remove the emotion from the equation, because that's a tall order. It's part of us. But I will ask you, how can we manage our emotions?
I don't think you can ever remove the emotion, whether you're new, whether you're experienced. I take myself, for example. Even when I look at stocks these days, you will naturally get drawn in. Your emotions will suck you one way or another. And really, the main driving ones are typically fear and greed. FOMO is one these days that are just constantly sucking people one way or another. And you're exactly correct. I don't think we should remove those emotions, but I think more or less if we're able to identify them, if we come in again with the right expectations and we understand that the emotions, the emotional cycle that we go through is part of the process, we can identify them and then make the right decisions because we've kind of assessed that. We don't want to just be going along at the whim of things. We want to pinpoint it, identify why I'm feeling this way, what can we do about it. I've seen so many times that investors are unfamiliar with this emotional cycle. It's just this psychological cycle that happens time and time again, starting from optimism, moving to euphoria, and then a bubble pops or whatever the case is. And when you're in the heat of that, it can be so tricky to manage things. But again, you come in prepared, you can kind of identify, hey, where are we in this state? Where are we in this cycle? Maybe make the right moves according.
Yeah, you mentioned something really important, and I hear it a lot these days, and not just about investing. It's FOMO. So, can you explain a little bit more about what that abbreviation means to some of our listeners or our attendees that don't know what that is?
Good point there, and I totally did just speed over that. FOMO, or the fear of missing out. This is something that I think everyone experiences in life, but especially in the stock market. It's when something is going on and you're kind of sitting on the sidelines, you're kind of on the outside looking in, and you're just itching away. And again, this could happen in life, whether it's a concert that you want to go to, whether it's a new show that you're missing out on, or in particular in the stock market, you hear on the news or you hear from your coworkers about a specific stock or a specific asset that's just on fire and making everybody a bunch of money. And it is so tempting for a beginner to then dip their toes into those fields, kind of, in many cases, overextend themselves into an area that they're not as familiar with. There's a ton of examples that come to mind, but by kind of dipping into that FOMO and again, letting the emotions get the best of you, that's when you start getting into a little bit of trouble. That's when the red flags should be kind of lifted. There's actually, personally for me, I don't know how closely you follow Warren Buffett, but that's somebody that I absolutely idolize. He's just really one of these big images that I think everyone can learn from. And he does such a good job of staying within his realm of what he knows. And sometimes it comes back to bite him in the sense that you may be missing out on certain investments or certain opportunities. But every day there's going to be things that are flinging by you and something exciting here or there. And I think it's actually a big mistake that investors will just be grabbing at everything that comes by, because in many cases it will come back to actually bite you in the butt.
Yeah, I mean, I feel like there's a story you're dying to tell about yourself here. If so, please share. We're all friends here.
That's fair. A couple stories. Let me just think off the top of my mind, Ryan. I don't want to say that I've fallen victim to this. I like to do my best to stay away from these types of FOMO situations and these volatile assets. But a couple things that I draw as a very good example in the recent future, in the recent history, is obviously Bitcoin. The big bubble and the cryptocurrency craze was one that, as I got into this whole YouTube journey and I started posting videos and seeing what was out there online, it was insane how much coverage there was on Bitcoin and cryptocurrency. And even in the near future, very recently, Ryan, marijuana stocks, not to get too particular, to get into too much detail, but as legalization happened here in Canada, that was another area that pretty much all sorts of stocks were just shooting up. And I very much would classify it as a bubble. If you look into these assets, you look into these companies, which aren't making a crazy amount of money, but there's all this excitement, there's all this hype that's just driving these prices up. People jumping in to make this quick short-term cash. Those are two examples that I think ended very poorly for a lot of people. And again, I'm not speaking here on personal experience, but as a YouTuber, I saw this happening all around me. And it just kind of delves back to that point that we first touched on, is that if you're able to just look long-term, and if we actually just take a look at this chart here, Ryan, this is one that I tend to find very, very fascinating. It's a chart that basically displays a bunch of major events that may have caused reasons for panic. It may have caused an investor to really get caught up in the times, because as you can see from a variety of these different topics, such as Brexit or the trade war, in the moment with the news, with the media, these are all very glaring things. But in the big picture, when you're able to advance out, you see how well the market performs. And it's truly a way to view it is there's speed bumps along the road. And there's another way to look at this that I actually find to be a little more applicable on a one-on-one scale, is if we took a look at just a random investment. And this is no investment in particular, but this is, I guess what you could say, a very typical performance of a fund or of a specific investment. What you notice is that the returns from year to year are so unpredictable. They completely vary. And that's what we say over the short term. We really don't know. You even see here in this given example, there's a couple of years showing negative returns. So negative performance, which is something that a lot of investors get all icky about. But when you're able to advance out and look at that over 5-year, 3-year, 10-year returns, in aggregate, they really start to smooth out. The little bumps along the way is exactly that. They're bumps along the way, to the point where you look at any long-term performance of a fund like this, or a specific investment, in this case XYZ we're looking at, you still do very, very well if you're able to hold for longevity. You let compound interest work for you rather than playing that short-term game, worrying about it year to year. It's very, very easy to invest properly if you're able to look out that far, and you can kind of, I shouldn't say easy. It's not an easy thing to do, but it's something that if you work hard and you put your mind to it, you can very easily avoid the red flags. You can avoid the dangers by just coming in with the right preparation and the right expectation, which is really, I hope to be what we're talking about in this presentation today, is just to help people become more aware of how to either handle volatility, handle the markets, or more or less come in prepared so that they can really take advantage of anything that happens.
I like the point that you made that, it's not easy, because we don't want to think of investing as easy. There are a lot of things to contend with. And it's so important that we not think it's easy, that it's a lot of work managing those emotions and everything like that,
That's a great point, Ryan. And I may have misspoke when I said easy. Actually, another quote that I absolutely love is that investing is simple, but not easy. And I believe that was also by Warren Buffett. And when it boils down to things, the concepts are quite simple, but the actual application of them, and when you factor in the emotions and everything that comes with it, like you said, it is not easy, but it's something that we can all work towards to really stay grounded and really do well over the long term.
Yeah. So you've spoken of keeping the numbers in mind. We see how the market fluctuates over the 10, 20-year period. You've kind of told us how to keep our emotions in check, or try as much as we can to keep our emotions in check. But do you have any concrete tips on how to stay resilient in the markets?
Concrete tips to stay resilient. I do have a couple that pop to mind here, Ryan, and they almost it almost takes us back to, like, in my opinion, by taking a couple steps back, that can actually set us so much far ahead when you're investing. Everyone tends to get caught up, and actually, if you bring it back to square one, my major tip would be, when you look at your investments, when you look at your portfolio, is it in the first place balanced? Is it set up as it should be to reflect your situation? And there's a term that you'll hear in the industry, and I'm sure a lot of viewers are familiar with, is asset allocation, which is very simply having the foundation of your portfolio set in the right places. And everybody's portfolio is different depending on age and risk factors. There's a million variables that come into play. But a major tip that I would say is that by taking a step back and looking at that foundation level, looking at your portfolio in the first place, in terms of the asset allocation, are you set up? Is that foundation laid so that you can go ahead and achieve your goals in a very responsible and effective way? That's a first tip that I think is simple, but actually does wonders. If your portfolio is not structured properly, you're far more susceptible to make these mistakes. And if you're seeing all this volatility because you're far too aggressive, or maybe you're even too conservative, it really depends on the person you're speaking with. If your portfolio doesn't align with your goals, that can be a major factor in not being able to ride out these markets.
And Brandon, when you talk, I want to talk a little bit more about asset allocation. How does that make a difference in, I don't know, in, let's say in the way, in whether the market goes up or down? How does doing asset allocation make a difference?
Really good question, Ryan. I think from the bottom level, what it boils down to is, and I like to say this to our viewers when they're just getting started, is you can look at your portfolio in a very simple way of safe assets, riskier assets, growth assets, income assets. And that balance between the two really dictates how much volatility you're going to see. If you have a portfolio that's fully built up of growth stocks and you're really shooting for the stars, well, you're going to see a lot of ups and downs with that. And for, let's say, a 50-year-old, a 60-year-old, a 70-year-old investor, that may be not what they're looking for. That may be a portfolio suited for a younger person. The same could be said if we flip that case around. And really what I think boils down to on the portfolio level, if you're looking at it from an investing standpoint, is that if you can structure things in a diversified manner, so you have, the way I like to look at it is if you have exposure to the different areas, whether that be the major asset classes, whether that be the different sectors, what that does when you spread out your eggs, when you spread them amongst different baskets, is it doesn't leave you overexposed to a specific area. And if there's one thing we know about the stock market, and we'll always preach this, is that over the short term, anything can happen, whether that be a stock going under, whether that be a sector getting slammed. And by setting that asset allocation, by having that plan in place, where you may have a little bit of money in energy and a little bit in gold and a little bit in technology, and you've really got your eggs spread, that doesn't leave you susceptible, or as susceptible, I should say, to getting slammed. But what that does in the meantime is that as the economy grows, as our world advances, and as the stock market pushes up, you are getting that broad exposure to everything. So that, to me, is what I would say is very important when you look at it from asset allocation. You could really break down as detailed as you want where you want to put your assets. But I think a very, very important takeaway would be to stay diversified. That's really one of the biggest tips you can take with you in being a resilient investor, not getting too concentrated in one area.
Yeah, and do we revisit this at any point, or we just kind of set it and forget it?
Very good question there. And I think there's actually, there's two ways to approach that. It totally depends on how you want to approach the stock market as an investor. I know some investors that are very, very active and they love looking at their portfolios. That's something they have the time to do. It's something they have the interest in. And in that case, you absolutely should be on top of things. You absolutely should be making sure you're on balance. Even if you do look at the opposing side to that, with the true set it and forget it approach, which there are many methods of doing that in the stock market, you can really set up a diversified portfolio. You can set a balance, make sure that you're on target from time to time, basically checking in periodically. That can vary. But of course, we set these goals for a reason. We set that asset mix, as we talked about, for a specific reason, because that relates to you. That's a portfolio that's right for you. You want to make sure that from time to time, you are not straying too far from that. You are just sticking to that top. You're sticking to that balance. And there's really many ways you could do that, Ryan. There's people that will put money. A very popular strategy here is, let's call it dollar cost averaging, or essentially putting money in on a consistent basis, which is something that I think almost everybody should be doing, assuming they're growing their portfolios. Putting that money in on a consistent basis as well does a very good job of smoothing out the bumps. It smooths up the up and downs. You can actually pick where you allocate those funds to, again, stay on balance. That, to me, is a very, very effective, at the same time, kind of an automated way of doing that, right? You can set these forms up like a systematic plan where you're just putting money in. You don't have to be looking at it every single day. In fact, I, for the most part, wouldn't promote that. Kind of let it naturally grow. But those are some tools that you can put in place so that you stay on your target, you stay balanced relative to what you're aiming for. We set these up automatically. We don't have to make that conscious decision in terms of, where should I put my money here, or should I put my money into my account? You set them up automatically. One that I know a lot of viewers either use or will find as a very interesting method of investing is utilizing DRIPs. So a dividend reinvestment program or a dividend reinvestment plan, where when your stocks pay you dividends every quarter or whenever you receive a little payment from one of your stocks, you can just cycle that back into your portfolio. You cycle that into that specific stock for that matter. And it's kind of like this feedback loop where, again, completely passive, completely automated. And that's just going to continually grow and compound your shares. It's just a very, very cool tool to use to, again, keep things passive as well as just keep that automation loop going.
Yeah, that's nice. I guess there's a second benefit to it, is that it removes a lot of that emotion you were talking about before because it's automated, right?
Exactly that. One of the things that I actually preach all the time is, if you don't have to be super involved with your portfolio, if you don't have to be looking at your quotes every day, looking at your performance, you're far less inclined to make a mistake. Again, if we kind of bring this full circle back to those, maybe first things we talked about with the long-term performance helping you out, the long-term performance being your friend. If you can let your investments do their thing and not make those short-term panic decisions, it's, again, simple, not easy to do, but that's how you can do very well in the stock market, is just by letting the nature of it do its thing.
Oh, that's amazing. Some great tips. Now, some of our audience maybe might just still not be comfortable. Their comfort level in investing is just not there. So what would be your take for them, if they're just not comfortable investing right now?
Yeah, that's I think a very important point. And I'm very glad you asked that question, because there are guaranteed people in the audience. There's a ton of people out there that just simply don't feel comfortable with the turbulence in the market, with everything we've spoken about today. And I don't think that's a bad thing at all. I think that when you invest, you should be doing it within your comfort zone. You never really want to find yourself in a position where you're overextended or where you dove into the deep end and now you're at a big risk of panicking and you've got all this money on the line that you weren't comfortable with. I think that it's completely fine to be a little bit uncertain. There are very safe investment vehicles that you could use to kind of get your feet wet, let's call it. You could even look in, for example, if you're very, very conservative and you really don't want to be part of the equity markets because there's too much ups and downs, you could start with looking at cash. You could look at a high interest savings account, for that matter, and just at least park your money somewhere where it's growing. You don't necessarily want to just be sitting on your money all the time, because then you do lose pace to inflation. But there are definitely vehicles for investing for a conservative investor, for somebody that's not so comfortable. And what I would say is really the two main takeaways is start with something you're comfortable with and then work your way up, right? You don't want to go through the reverse and dive into the deep end. You can start with, let's say, a lower or a medium risk strategy and then move up. I think that's the way to do it, really, if you're somebody that's very, very uncomfortable. And then the second component that I think would really help you out is just continuing the education, in the sense like our conversation here today should be hopefully proving to you guys that, yes, there are ups and downs in the market, but that's something that's absolutely normal. That's not out of the ordinary. In fact, that's actually what comes with the stock market. That's what comes with being an investor. And the more you educate yourself, the more you can do the work up front to have the right expectations, to really know what you're getting into. That may be a good point. That may tip you one way or another in terms of actually putting your money into the markets and becoming more comfortable with being an investor. Those are probably a couple things that come to mind there for me, Ryan.
Really great. I know some people ask me, should I invest or should I pay off my loans? What would you answer to that?
That is a very, very good question, Ryan. And I think, unfortunately, there isn't necessarily a blanket statement. You'd have to take every situation as its own situation. And of course, we wouldn't want to be giving any direct advice here. But I don't, again, basically what we want to look at it in terms of opportunity cost, we want to just do what's best. There's the monetary side of things, and then there's also our emotional side of things. There's the psychological aspect of carrying debt, let's call it. And if there's one thing that I would just start off with is that if you have any, credit card bills, if you have any extremely high interest payments to be made, that may be a very obvious place to pay down. If you have any screamingly high interest loans out there that could be wiped out easily, I think that's almost a given that you could say in terms of some general broad direction. But I think you have to ask yourselves a bunch of tricky questions there, a bunch of hard questions like how much do you value paying off debt? I know people that personally just say, I don't want to have any debt. They don't want to have a mortgage for that matter. They want to pay off their home and be debt free. That's a very high point of emphasis to them. You could also argue in today's environment that with interest rates being relatively low, it's not the worst thing to carry a little bit of debt. That's kind of the environment, that's the world we live in. So again, there's not a black and white answer to that. There are a number of questions to ask, but to kind of summarize that point, Ryan, I think both can be great options. I think you can do well both in the stock market. You can do well both by paying down debt. It's just you look at it in terms of opportunity cost, where's the best place for your money, along with, like I said, the psychological factors of what's important. What do you personally value there more?
I wanted to ask you if you have any final words or pieces of wisdom for our audience today.
Do I have any final words in wrapping things up? Wisdom, I would just first of all say, I think if anyone has stuck around this far into our conversation, and if someone's attended the webinar this far through, I would just say, first of all, a big congratulations to the viewer at home. And I know this isn't as much wisdom as it is more or less just my thoughts on this, but the fact that you, the viewer, the fact that anybody at home is watching this and taking the time to learn more about the stock market, to educate themselves, I couldn't congratulate anybody more than that. It's seriously, it all starts with just taking the time to learn and learn and learn and absorb as much as you can. And investing, at least the way I view it, is this long journey that people start at many different phases of their lives. But what it's all about is at this point, what can I learn tomorrow? What can I absorb? And you will always be learning things, whether that's how to be a resilient investor, whether that's tips from somebody you know, what to do this or that with your portfolio. There's really, the learning never stops. And the one thing that I would just say as a main takeaway is continue the education, continue absorbing, continue diving into this field, because this is a very, very valuable field to be in. When you learn to invest, these are things that you can take with you for the rest of your life. That would really be my main takeaway. So good job to anybody watching. And Ryan, you guys at the team for having this whole presentation set up. I think you guys are doing amazing, amazing things.
Well, thank you, Brandon. And you're doing amazing, amazing things. If it is education that we're going to really take away from this session, both you and us here at TD, we are excited to have you learn as well. So thank you so much to Brandon for being here. For those of you in the live session, we now move on to questions.